First of all, we'll have a little overview of what we covered last time. Since last time we could not get proper recording of that, and there are some students who are taking this course as a distance learning student. We started last lecture with the overview of finance and what is the role of financial managers. We defined finance as an art and science of managing money. So we discussed this, that if there is, in a perfect world, if we have a requirement for funds and those funds are available, then there is no question of financial management. But it does not happen in the real world. We usually come across two types of scenarios. Sometimes we are in need of funds and we don't have those funds available at the moment, at the right time when we need those funds. And at certain other occasions, we have surplus funds for which are lying idle with us. So finance is all about dealing in these two situations, that if we are in need of funds, if we want additional funds, so what are the different sources through which we can meet this requirement of additional funds? And if we have surplus funds, so where we can utilize those funds to get, once we are looking into the getting for additional funds, so basically we are interested in economy, that we want to get our required funds at the most economical rate or economical conditions. And once we are looking for investment or spending our surplus funds, at that time we are looking towards the profitability, that where we can get the maximum profit out of it. And usually in investment, two things matter. One is the return and the other is risk. So financial managers are the one who evaluate risk and return. So the ideal situation is where the risk is minimum and the return is maximum. So they go for those projects, or they go for those investments in which the risk is minimum and the return is maximum. Then we discussed the difference between public finance and business finance. So public finance is that branch of finance which deals with public money or the government funds. We all come across this federal budget in the month of June. So what is it all about? The federal budget is all about what are the sources from which the government is going to generate the revenues and where this money is going to be spent. And obviously in case of Pakistan, we always hear this term of deficit. So this deficit, what are the sources through which this deficit is going to be covered? Like our expenditures in general exceed our revenues. So this is what our federal budget, every year we come across this federal budget. So in public finance, we are dealing with the public money. So what are the sources of generating the money? What are the different government projects, government priorities where government want to spend those funds, and what are the sources through which those funds will be generated? Once we talk about business finance, so we are basically talking about a particular firm or corporate world, or a corporation. So what are the sources of funds for a particular firm, and how those funds will be utilized by the company in the most efficient manner, like to generate maximum profit out of it. Then the role of financial managers, what financial managers are dealing with. So there are four major responsibilities or four major activities of the financial managers. One is forecasting and planning. That is, once you are doing the business, so you want to look into the future, that what will be our future requirement of the funds and from where we are going to meet those funds. So we do not want to end up in a situation where we are short of funds. Why? Because if you borrow funds from outside sources, it means additional cost of the business, and that will hurt your profits. Then investment and financing. These are two other important decisions which are done by the financial managers. Investment deals with the usage of funds, like to acquire additional assets, to invest money in some other projects. So that those decisions are investment decisions, usually relate to the asset side of the balance sheet. So balance sheet has two sides. Left hand side is the asset side and the right hand side is the liabilities and owner's equity. So these are the two sides of a balance sheet. And this balance sheet is based on accounting equation which says that at any point in time our assets should be equal to liabilities plus owner's equity. Now the investing decisions, once we are talking about investing decisions, so that investing decisions relate to this left hand side of the balance sheet. And when we talk about financing decisions, that is mostly related to the right hand side of the balance sheet. So financial managers, they deal with these both aspects of the business, that what should be the size of the firm, how much should be invested in the current assets, how much should be invested in the fixed assets. We discussed last time the difference between current and fixed assets. Anyone who can tell the difference between current assets and fixed assets?
Current assets are your stocks and
stock, you mean inventory, right? Inventory, okay. Okay, cash. How we can differentiate in a easier way the difference between differentiate between current assets and fixed assets. Current assets are those assets which are either cash or which can be converted into cash within 1 year. So the life of the current assets is short term, and that short term usually is one year. Whereas the fixed assets, they usually have a longer life. When we say longer life, we mean our intention to acquire those assets is to retain for a longer period of time and to generate revenues by the usage of those fixed assets. So that is the main difference between these two, current assets and fixed assets. So how much should be invested in current assets and how much should be invested in fixed assets, that is the decision which is to be made by the financial managers. In financing decisions, what should be the capital structure? And when we say capital structure of a firm, we mean what should be the percentage of debt and equity. So whenever we start a business, we need funds for that. Those funds can there are two sources to acquire those funds. Either the investor has to bring the funds from his own sources, which is called owner's equity, or the funds need to be borrowed from outside sources, which is debt. So what percentage, if the total size of the firm, total assets of the firm, so out of those total assets, how much should be financed by means of debt and how much should be financed by means of equity. So that decision is to be made by the financial manager. Each one of them has its own advantages and disadvantages. Debt financing means we have to pay interest on that, which means there is a fixed cost associated with debt financing. Whereas equity, we do not have to pay a fixed cost, but equity means that all the funds either have to be brought in by the owner himself, or if it is a corporation, then all the funds are to be contributed by the shareholders. So if shareholders are contributing the funds, then we have to pay them dividends. So financial managers, they need to decide that what is the optimal size, what is the optimal capital structure. Another very important role for the financial managers is coordination and control. Like financial managers are the one who are coordinating with all the different departments functioning in a business. Like if it is a production department, it is a marketing department, if it is IT, R&D, so all these different departments which are working in a business, in a company, the financial managers are coordinating with each of them. They are taking their requirement, their financial requirement, how many funds they require in a specific time period, and then at the same time they control their usage of funds. So on one side they are providing them the funds, on the other hand they are also controlling them, that okay, this is the allocated budget for you and you have to you have to operate within that allocated budget. So that is the role of the financial managers. And the last role that we discussed was interaction with financial markets. So financial markets like capital market, this stock market is there. For borrowing, you go to the different financial institutions. So financial managers need to be well conversant with all these aspects. What are the sources from where the debt financing can be arranged? What are the different venues where additional funds can be invested in the most profitable manner? So only if the financial managers are well aware of these financial markets, they can make right decisions for the business that will result in the maximum profit for the business. Financial management is essentially a combination of economics and accounting that we discussed. When we say economics, economics means that is the practical aspects or the policy matters. So policy matters are basically based on economic theory, and when we say accounting, that is basically record keeping. So all the data, all the record financial data is maintained using the concepts of accounting. So both these field of knowledge have a great impact in financial management. Financial management concerns the acquisition, financing and management of assets with some overall goal in mind. And this overall goal usually is, what is the objective that we discussed last time? Anyone? What is the objective of the business or the corporations? What they are striving for?
To maximize the shareholders.
To maximize the shareholders' wealth. That we discussed, that is the main objective of the businesses. Or when we talk about corporations, in corporations the board of directors are working there and their objective is to maximize the shareholders' wealth. Then it can also be defined as a process of obtaining, deploying and utilizing monetary resources in order to achieve organization's goal. And the decision function of financial management can be broken down into three areas: the investment, financing and asset management decision. This slides describe or briefly shows what these three decisions are, and we already have discussed that. Investing decisions mostly are related to the asset side, that what is the size of the firm, what should be the total assets, composition of assets, and even disinvestment. Sometimes the business realize that certain assets are surplus and they are counterproductive. Rather, instead of bringing in the profit for the business, they are rather resulting in additional cost to the business. So at that time disinvestment should also be done, and that is where financial managers, they give their input that we need to get rid of those assets. Then financing decisions, to the right hand side of the balance sheet, these are related to long-term financing and equity. What type of financing should be there, what should be the financing mix, and what should be the dividend policy. So dividend policy, any idea what is dividend? Right, whatever share of profit we give to the shareholders is the dividend. So now should we give all our profit, distribute all our profit among the shareholders, or should we retain certain portion of that? Because each decision has its own impact, right? So we want to
Normally what is the way that they do it? Do they
normally, generally, not all of the profit is distributed. It depends on the like what kind of projects the business is undertaking. Like if there is certain expansion going on, or if they are planning to acquire certain fixed assets, at that time the ratio of dividend is usually very less. But if the business is going perfectly fine, they are not planning any capital expenditure, at that time the dividend is usually high. And if we talk about Pakistani scenario, so what we find in those corporations in which there is the foreign investors are involved, those businesses are giving pretty good dividends. They are paying pretty good dividends. But those businesses which are totally owned by the Pakistani investors, in those the payment of dividend is not that regular, like off and on. Sometime they pay dividend in 1 year, next year they might not pay any dividend, so it keeps on changing. The policy is not very consistent. The consistency is there in those companies in which there is foreign investment, like foreign shareholders are there.
So what is this financing mix?
Financing mix is mix of this. We have to mix debt and equity. So that is financing mix. What portion should be debt and what portion should be equity. And the last is asset management. So fixed assets, the management of fixed assets we usually consider it as investment decision. So what is left over is the current assets. So working capital management is basically management of our current assets. So that area, like in short term, if we have certain liabilities, so what are the sources to meet those liabilities? That is working capital management. Okay, working capital is short term financing. Working capital usually is our current assets minus current liabilities. That is net working capital. So net working capital, we define net working capital as current assets minus current liabilities. So current assets, we already discussed those assets who have a very short life, like their life is less than 1 year, and the current liabilities are those liabilities, those loans or debts which are payable within 1 year. So we are basically looking at the short term perspective. We are managing our short term monetary requirements, and that is by means of our current assets. We have to have sufficient current assets so that we can meet our current liabilities. Otherwise, what will happen, say we have to pay to some contractor, or maybe to some bill is due, and if we do not have the sufficient funds available, ultimately we have to borrow the money. And if we end up borrowing the money, it means additional cost, because borrowing has its own cost in terms of interest, so we have to pay that. So this is the summary of whatever we discussed. What are the decisions related to current assets, what are the decisions related to fixed assets, current liabilities, long-term debt, equity. So all these decisions are in the area of responsibility of financial managers. Okay, this we discussed last time, the organization of the finance team, and this chart typically is a organizational chart for a corporate corporate sector. Like we have a board of directors which is elected by the shareholders, and then this board of directors select a chief executive officer, CEO, and CEO is the one who is implementing the overall policy for a business through all these different heads of the departments, and usually these heads of the departments are entitled as vice president. So there can be a vice president for human resource management, vice president for information technology, vice president for research and development, vice president for marketing, and vice president for production. In a typical manufacturing concern, we can find all these departments, but these departments can vary depending upon the nature of the business. Then there is a staff position which is Chief Financial Officer. This CFO is a staff position who is reporting to the CEO, but at the same time he is coordinating with all different heads of all different departments, vice presidents of all different departments. And how this office of CEO is organized, usually we have two different branches. One is headed by the treasurer, and the other is headed by the controller. The area of responsibility of treasurer and controller is also different. The controller usually is handling the accounts. So whether it is cost accounting, financial accounting, sometimes information systems as well, is under the supervision of controller. Whereas the treasurer is looking after cash management, how we are going to manage our cash, because cash is the most vulnerable asset. If we are not managing cash properly, we are losing our business big time. So there has to be a very effective cash management policy in the business. Then the credit management, again, last time we discussed this, that account receivables. Anyone, what is account receivables?
Which are your firm.
Due, but how they are created? Account receivables, how they are created, like what is the source of account receivables?
Like you give a credit to, you give a product to
someone on credit.
On credit.
Right.
1 month, 3 months, 6 months.
Right. So
So
practically it is a credit sale. So in credit sales, the terms usually are you give credit for 30 days or 60 days or 90 days. Very rarely you will find any company giving credit more than 90 days. So
an example of this credit management is the credit card, which normally the banks they give to the
right, they give you a
purchase items on credit and make the payment within 45 days or more.
right. So then each company has to define its credit policy and then implement that policy so that the account receivables are kept to a minimum level. Because if the account receivables are too high, two type of problems can arise. One is your funds are blocked anyway. Secondly, bad debts will happen. People will end up paying nothing. So that problem, to avoid these two problems, there has to be a very effective credit management, and that credit policy, credit management is to be ensured by the treasurer. And then the financial planning involve all these investing and financing decisions that we already discussed. So these two important positions are there, treasurer and controller, in a large scale organization. In small scale organization, maybe CFO is the one who is looking after all the functions. There might not be a treasurer or controller. Or this organizational chart can be a very simple organizational chart. It cannot be, it won't be that elaborated. But if it is a large scale organization, then we'll find all these type of different positions, and each position will be handled by a very proficient or efficient, qualified individual handling these functions.
In financial planning and budget planning is the same.
Budget is part of financial planning. It's part of financial planning. Okay, the last thing that we discussed was this three forms of business. It is important to understand each one of them, because when we talk about different financial statements, not today but hopefully next lecture will be about financial statements. So financial statements of the businesses vary depending upon the form of the business. If it is a sole proprietorship, sole proprietorship is a business in which sole means single, proprietor means owner, so in which there is a single owner. If single owner business is there, the financial statements will be quite simpler. In case of partnership, the business will be owned by 2 to maybe up to 20 people. The financial statements will be a little more elaborated, because the partners want to ensure that each one gets his proper share out of the profits. And when we talk about corporations, then obviously the financial statements have to be perfect. Why? Because when we discussed that the corporations can be public limited company and private limited company. So public limited company means in which there is the money of general public involved. So it is the responsibility of the state to ensure that this money is safe, and to ensure that security, safety, the state is the one which define different policies to ensure the transparency of the accounting records of the corporations. And as we mentioned last time, that there are two main regulations, two main aspects which are there for the corporations. One is they need to have an annual audit of their accounts, and secondly they need to publish their annual reports. So the idea is to communicate the financial position, to communicate the results of operations to each and every individual, to each and every stakeholder, so that the element of transparency is there. Then we discussed the advantages and disadvantages of each form of the business. As far as the sole proprietorship is concerned, the advantage is obviously it is owned by one person, so ownership by one person means maximum freedom of action. So that is the greatest advantage of sole proprietorship. Easy formation, usually there are not many legal requirements, maybe small, maybe couple of requirements you will fulfill and you can register as a business. And there is only one tax, which is at the end of the financial year. You have to the sole proprietor has to file his tax returns with the tax department, and whatever tax is calculated on that is to be paid only once. As far as the disadvantages are concerned, the biggest disadvantage is unlimited liability in case of losses. The losses usually are covered from the sources of the business, but if the magnitude of losses is high, it cannot be fulfilled from the business sources, then obviously one's personal assets will also be accountable for that. The second disadvantage is difficulty in raising funds. Like if you are the only owner, the size of the business will usually be small because the fundraising capacity of an individual is very less. And it lacks continuity because the life of the business is dependent upon the life of the owner. But one thing to be noted is many large corporations which we see today, they were started as a sole proprietorship. Like one person started that business. Ultimately, that business became so successful that it was converted into a corporation, and then the next stage was it became a multinational. So in partnership, two or more people can be there. There can be general partners and limited partners. General partners whose liability will be unlimited, but one or more limited partner can also be there in a business. Limited partner, his liability will be limited to the extent of his ownership. Important thing for partnership is to prepare a partnership deed, so that all whatever rights and responsibilities of each partner are there, they should be outlined in that partnership deed. Why partnership usually fails? The reason is the rights and responsibilities are not defined at the start. जब partnership start हो रही होती है तो उस वक्त तो कहते हैं ठीक है जी कर लेंगे मिलके, but nobody defines the right, who is going to do what, and in case of disagreement, how the decisions will be made, and if one partner want to leave, what will be the mode of that. So these things are never decided before the start of the business. That is why the partnerships end up in a failure. But if a proper partnership deed is executed, in which all these responsibilities and duties of each partner as well as his rights are outlined, his entitlements are outlined, so the chances of dispute will be minimized and the life of partnership will be it will be extended. Again, the problem with partnership is the life is dependent upon the life of the partners. As soon as one partner die or leave, that partnership is terminated. So general partner, in general partners, their liability is unlimited, whereas the limited partners, their liability is limited to the extent of their own investment in the business. Okay. A long list of advantages for corporations, very less disadvantage. As far as the advantages are concerned, limited liability. If you have purchased share of any company, in case of heavy losses, the company cannot ask you to contribute more. Whatever you have invested, your liability is limited to that. Permanency. People may come, people may leave, the business will keep on going because the shares are transferable, negotiable instrument. If you are satisfied with your investment, you can hold your shares. If you are not satisfied with your investment, you can sell them in the stock market. Somebody else will purchase. So permanency, the element of permanency is there. People keep on changing, shareholders keep on changing, but the business is maintained for a longer period of time. Again, ability to raise capital. Now, one is obviously shareholders are there to contribute, but at the same time outside parties like the creditors will also be willing to give loan as on easier terms as compared to sole proprietorship or the partnership. Then it has a board of directors. So board of directors means there will be a specialized management team. So specialized management team will obviously result in a better management as compared to sole proprietorship or partnership. The owners are the shareholders, stockholders or shareholders are the same thing. Flexibility as I already mentioned in terms of selling your shares. So if you want to retain the shares, that is up to you. If you want to sell your shares, you have every right to do that. Another very important aspect of corporation, it is a legal entity. The law treats a corporation as a separate legal entity. It means you can maintain a bank account in the name of the company, you can purchase property in the name of the company. So as far as the legal status is concerned, a corporation has a separate legal entity. That is another advantage of it. And the last is easy marketability of shares of ownership. So you can easily transfer your ownership, you can easily sell your shares whenever you are in need to do that. As far as the disadvantages are concerned, first of all, there are many legal requirements to launch a company. It's not easier as compared to sole proprietorship and partnership. A corporation, when you want to launch a corporation, you have to fulfill many legal requirements. And another disadvantage is double taxation. How it is double taxed? Anyone, any guess? First of all, the tax is there on the income of the company. Like how the income is determined, how the profit of the business is determined. There are revenues, then we deduct our expenses. So we get profit before tax. The tax is charged on this amount. Once you deduct from your revenues, you deduct all your expenses. So whatever is left over, that is the amount on which the tax is calculated. You have to pay tax on that. So tax is deducted from this amount, and the leftover is your net income. Yeah, second tax will be there. So one tax is this, which is paid on the income of the company. Now what we are going to do with this net income? This net income, there are two uses, two things can be done with it. In a corporation, once there is a income, we can distribute some of it or all of it, it depends upon the decision of the board of directors, among the shareholders in the form of dividend, and then we can retain certain portion in the form of retained earnings. So it depends upon the decision of the board of directors what they want to do with this net income. As I already mentioned, that if we have certain capital expenditures in the pipeline, so obviously then retained earnings will be more. But if there is no such plans, then maybe dividends would be higher as compared to retained earnings. Now this dividend is given to shareholders, but tax is deducted from it. So there is this double tax. That is how the income of corporation, we say there is double taxation. One is the tax which is paid by the company, and then again once the dividend is paid to the shareholders, the tax is deducted from that. So that is another disadvantage, we can say, of the corporation.
Is this by some law?
It is by, no, it is by law. Tax deducted.
What is the reason for this tax cutting?
Capital gain, the government define it as a capital gain. So they, like if you maintain a bank account and you are getting profit from there, so they deduct it right away. Like the tax is deducted from your salary. So it is defined by the government. Source of income, if you are getting income from certain source, so the tax at a certain rate is to be deducted from salaried class, This is capital gain. If it is coming from here, if it is profit from a bank, even in that case the tax is deducted. Even sometimes it is not very high profit, but still you find once you get your bank statement from the bank, you see why this deduction is there. So they tell you that it is the law, it is the rule, that tax according to tax rules and regulations we are deducting this amount. So it is defined by the tax department. हमारी होता है सैलरी की बात करें, सैलरी तुम्हारी हर महीने कट रही है।
हर महीने मतलब वो चॉइस होती है ना कि आप साल के बाद टैक्स देते हैं या
ना अभी तो टैक्स डिडक्टेड एट सोर्स, वो तो आपकी तो
नहीं वो दैट इज फाइन, लेकिन मेरा कहने का मकसद ये है कि जैसे अगर कोई इस तरह की प्राइवेट आप अगर पे दे रहे हैं तो एंड ऑफ द ईयर आप टोटल कॉस्ट जो आप कमाते हैं उस पर आप टैक्स देते हैं साल। बेसिकली हमारी होती है सारी क्या हमारी वो
start our lecture number 2, which is about financial markets, financial institutions and interest rates. Let me make it clear to you, the first two lectures are basically, we are not going into the depth, rather we are covering the broader aspects. We are just giving an overview of each and everything. So we are touching too many topics, but from next week onward, inshallah, we will be very specific. We are covering one topic in detail. So, but before we go into the depth of those topics, it is very important to have an overview of all these things. What financial markets are, what are financial institutions, and how this interest rate is determined. Okay, first of all, this capital allocation process. So, in a well-functioning economy, capital flows efficiently from those who supply capital to those who demand it. So, who are the suppliers of capital? Most of the time, these are the individuals who have surplus funds, like in the form of savings. They have surplus money with them. So, in a economy, these individuals and institutions, they act as the suppliers of the capital, suppliers of fund. And as well, as far as the demanders or users of capital are concerned, again, these can be individuals who are in need of funds, like whether they want to start a business or whether they want to fulfill their own individual needs with those funds, but they need additional funds. And these can also be institutions who want to use those funds in their business. So these two groups exist. One are the suppliers of the funds, which can be individuals as well as institutions, and the demanders or users of funds, which can again be individuals and institutions. We all know market. The market is a place where goods and services are exchanged. So when we talk about financial markets, a financial market is a place where individuals and organizations wanting to borrow funds are brought together with those having a surplus of funds. So basically, it is a place where this exchange of funds is facilitated. The ones with the surplus funds are brought in contact with those who are in need of funds, and the terms and conditions are negotiated, and then this transfer of funds takes place in a financial market. Different types of financial markets exist. One is this physical assets versus financial assets. Physical assets we all know in the form of machinery, in the form of motor vehicles. Financial assets, what can be the financial assets? Cash can be shares, it can be bonds. So physical assets market versus a financial assets market. So in physical assets market, exchange of physical assets is taking place. Somebody is paying for them and purchasing those physical assets, like somebody is purchasing a car or machinery or electronic equipment. But in financial assets market, the exchange of financial instruments is taking place. So financial instruments are shares, bonds, T-bills. So these are financial instruments which are exchanged in financial assets market.
T-bills,
Trade bills. Trade bills, I'll cover them in next slide once we talk about money market. Again, another classification of markets can be money market versus capital market. Money market is a place where short-term financial instruments are traded. short-term financial instruments. Short-term financial instruments. And once we say short-term, again, we mean those having a maturity of less than 1 year. Maturity of less than 1 year. So in a money market, the financial instruments which are traded, those financial instruments have a life or maturity of less than 1 year. Maturity, any definition for maturity? Maturity means when they will become due. So if you are purchasing a T-bill, trading bill, the life of the trading bill is usually 90 days. So after 90 days, you will get your money back. Maturity period of a trading bill is 90 days. So in a money market, those instruments are traded which have a maturity of less than 1 year. Like in less than 1 year, you will get your money back. But in a capital market, long-term financial instruments are traded. And once we say long-term financial instruments, long-term means having those instruments having life more than 1 year. So they will not mature in 1 year, rather they will mature later than that. So those are capital markets. For example, shares and bonds, they are traded in capital market. Bonds are debts which are taken by the corporations, and they have a maturity of 5, 10, 15, 20 years. And I shared with you last time, Coke and Disney, they issued bonds of maturity more than 100 years. So capital market is the one in which long-term financial instruments are traded.
Otherwise, the bonds are issued different bonds.
That is a different bond. You are talking about price bond. Price bond is a different concept. Price bonds is not that one which we are talking. These bonds are known. These are debt instruments which are issued by the corporations. These are not price bonds. They are not cashable. They are negotiable. You can sell them in the market, but they are not cashable from the company. The company will return your money back on the date which is printed on the bond.
Plus some dividend.
In case of bond, there is a fixed return in the form of interest. So usually every 6 months they pay you.
So they keep on paying the interest.
Right. Like the 100-year bond, they will keep on paying you interest for 100 years.
And at the end of the 100 years, they will tell you that $10 which they took from you.
The principal amount will be detailed. So that is not attraction. Attraction is that interest that you earn in the period of 100 years. The principal amount will lose its value after 100 years. As you said, it might be $10. So
after 100 years, that $10 would have no value.
But the importance for the investors is that money which they are getting after every 6 months or 100 years. That is important.
Insurance policy also.
Yes, insurance policy I also mentioned. Okay, primary versus secondary markets. Primary markets are those in which the transfer of fund is directly between the individual and the financial institutions. For example, if Nestle is selling its share to the public, so that will be a primary market transaction. Nestle directly selling share to the public. So if I am purchasing the share, I am paying the money, that money is going directly to Nestle. It's not going to any other individual. So that is primary. But in case of secondary market, the example would be already issued shares of Nestle. Nestle has already issued the shares which are with Mr. XYZ. So there are so many individuals who are having those shares. Now, if Mr. X is selling the share and Mr. Y is purchasing the shares, so this transaction would be a secondary market transaction. It will not be.
Which normally takes place in the stock market.
Right. Stock, yeah, that is secondary.
Stock exchange, which the daily the trading of shares.
Exactly. That is secondary market.
That is secondary
That is
market.
secondary.
And the initial launching of shares by any company,
That is primary market.
which actually sells at its original price.
Right. Right. And the money is going directly to the company.
Money going directly to the
So
company.
that is primary market.
That is primary, and secondary is the one which is stock.
Spot market versus futures market. Spot market, when you pay for a commodity and you get that commodity on the spot. Our daily transaction, what we purchase, we go to the market, we purchase something from the shop, that is spot market.